not for some reason, I will endeavour to come back as soon as possible. But it may not be immediately possible, so we may have to break the session up. I hope that isn't the case, but I'm just warning you in case something goes awry. So Liz asked me to address the topic of governance, and I think that obviously governance is such an important issue in any organisation, but particularly in not-for-profit organisations, in organisations where we are using resources, whether they are public funds or whether they are the funds of the community that we're serving, or whether they are resources that are donated in some way by the people who are volunteering to be part of our organization, for example. It is absolutely vital that we honor the trust that has been put in us, and that we are accountable. So governance is really about transparency, accountability, and it's about aligning our management plans and our implementation with our structures, our governance structures. So we need to start with understanding what is required for different kinds of structures. And in general, most community arts centres we found on having done some research around this are set up as not-for-profit organisations. Now, of course, this is not very cast in stone. There are examples of community arts organisations that are not not-for-profit. The majority tend to be set up as an NPO or a PBO, public benefit organisation, in order to be able to benefit from public funding. So in other words, to be able to apply for government funding, whether it is, let's say, lottery funding, or because these are arts organisations, it could be funding from provincial arts bodies or the National Department of Sports, Arts and Culture, or some other entity that is focused on supporting the arts in communities. So the three main structures that people would have to turn to within the South African legislation are voluntary associations, which is the simplest form of association, then not-for-profit companies, which is a kind of refreshed version of what used to be called Section 21. And these are similar in structure to for-profit companies, but obviously they have a non-profit motivation. And then the third form that many people select is that of trust. So these are the three main varieties, if you like, of not-profit organizations. And we don't need to be registered at all. However, if you choose to register as an NPO, you then have the opportunity to apply for funding. So you cannot apply for government funding without being registered through the Department of Social Development as an NPO. So there are different choices that one can make. Essentially, a voluntary association could be just 3 people who are coming together with a common purpose and who are volunteering to do that. But most NPOs, voluntary associations, will in fact get a little bit more structured. They will appoint a steering committee, they will open a bank account, they will draft a constitution, they will register with the Department of Social Development and get an NPO number. And in some instances, they may choose to also register as a PBO, so a public benefit organization. This is a registration that you would get from SARS. And essentially, it gives you certain tax benefits. So it's not about your it's not about how you are constituted, but rather it's giving you benefits in terms of the tax legislation. Then I mentioned trusts. So trusts have trustees rather than members, like a voluntary association. And you would need to register with the Master of the High Court. And with trusts, you can generally make you don't need to necessarily have as large a committee regulating the running of the trust, although it is often considered a good practice to have a large group of people. But you need to have obviously very trustworthy trustees, and you do have a choice also to register as a PBO with SARS. One of the downsides of being a trust is that if you do get any taxable income, it will be taxed at a higher rate than if you are there as a not-for-profit company. And then the third variation is the not-for-profit company, and there are, again, different ways of operating as a not-for-profit company, but essentially you have to have a memorandum of incorporation, and your registration would be happening with the CIPC. Then, as a not-for-profit company, you could make the choice to also register as an NPO with social development. In other words, you'll be able to benefit from public funding. So as you can see, there's quite a lot of overlap between these different structures. The point is, though, that once you have registered with, let's say, CIPC or with the High Court or with the Department of Social Development, you are going to have certain obligations that are really important, that you have to make sure that you are able to fulfill on an annual basis. And some of those would be, for example, providing an annual report. And the Department of Social Development gives you a format for that report. Depending on the size of your income, you may need to have audited financial statements, or at least financial statements that are signed off by an accountant who has a slightly smaller budget. And so these are the kinds of things that can, over time, become more onerous, and they require more work from you to understand how to make them operate in the best possible way. I think one of the important things to speak about in terms of governance is that governance also refers specifically to the board that is overseeing the management of the organization. And in many organizations, there needs to be a kind of a division between the board that is there for the oversight and the staff or the volunteers or whoever's doing the actual work on the ground. In many instances, what happens is that a volunteer board does the work when an organization is initially formed. But over time, as it becomes more formalized, so these different duties may be split. And it's important that they are split, but we need to have people who are able to hold us accountable. So if we are the people who are running the organization, we need to make certain that any money that is being received is being treated, as per the funder's wishes or the donor's wishes, and that it's also, we are following whatever protocol are required, whatever laws are applicable to us in that instance. So having a trusting relationship between the board and the management is really, really vital. And we could talk a little bit about, how we build that relationship, how we build that trust, how we select our board, how we ensure that we have the right people and how we hold them accountable as well, because I think it's really important that board members, even though they might be volunteers, that they see themselves as being, they are really important cogs in the wheel, and their integrity, their accountability is vital to ensuring that an organization flourishes. Boards are meant to operate according to a set of principles, and in South Africa, those principles have been articulated by the King Commission. And so we speak about King 4, which is essentially a set of principles which have been put together by the Commission that essentially boil down to things like integrity, and trust, transparency, and a number of other sort of really fundamental elements of governance. And if you don't know the King 4 report, I would really our governance toolkit that Stand has created. In fact, Asatej worked on the content of that toolkit, and Stand is training trainers in the toolkit at the moment. But it goes into detail about things we look for in terms of what's called iCraft. So the qualities that we're looking for in our non-profit organizations or in corporate as well, so it holds for anybody who's working under the organization. Maybe just one other comment is that, as I mentioned earlier, there are certain things that are applicable in terms of tax compliance. If you decide to go the route, for example, of becoming a public benefit organization or a Section 88 status in order to be able to give people who donate to the organization a tax benefit. So again, that's a very specific element of governance that needs to be taken into consideration. And the document goes through a lot of details what those particular things are. I think where we want to lead with is that as an organization or as an organization, it is much clear around basic principles that you craft your vision, mission, your productivity, not just as a set of activities to be achieved or a set of goals to be reached, but also as a way of operating. So in other words, you need to be also developing a code of ethics, which will which you can hold one another accountable to, which will talk about things like honesty, conflict of interests, misuse of resources, favoritism or abusive behavior within your organization. What are you going to do, for example, if people are unproductive, if people do not commit to the things that they have said that they're going to be doing? So all of these things, these ethical codes of behavior need to be agreed upon by everybody who is part of an organization. And it's important to think about what will we do if how do we want to values we hold dear in our instance. Is legal, of course, that's legal. And I think that having an organization gives you an opportunity to get to know one another better, but also to really ensure that everybody who is there is on the same page about the level of care, skill, loyalty, and commitment that they're going to bring to the work that they're doing for the organization that they are, intending to try and make flourish. So I'm going to leave it there for now, but I'm sure there will be questions later. I'm sure you may have very specific questions. Governance is obviously a very huge area, but I want to make sure that I don't lose connection with you at this moment. And hopefully, if I do lose connection, I will be able to rejoin you later and answer some questions later. Thank you.
Okay, thank you very much, Yvette. It was very insightful. Just a quick question that I think also people on the floor would like to hear. You mentioned that you get to choose in terms of how you are going to register your organizations, either as an NPO, NGO, a trust, or a volunteer association. Now, the question is, as far as the public benefit organization, can you directly register as a public benefit organization without being an NPO or a trust? Yvette? Okay. She's really struggling in terms of connection. She advised earlier on that uh, she has a challenge when it comes to battery. So we'll then move on to Mr. Mulauzi. Mr. Mulauzi, are you ready for us? Then we'll take questions after. Mr. Mulauzi.
Hello?
Yes, thank you very much. Also, Yvette is having some challenges. So
Mm.
will join us later on. So then we'll get to tackle those questions later on. And I advise that we go to your presentation, and then after we'll open a floor for questions and
For
answers.
questions.
Thank you. Yeah.
Okay, thank you so much, Leslie. Eh, I hope that I'm clearly audible. Am I audible? And is it clear?
Yes. Yes. Yeah.
Okay, thank you. So I actually have prepared a slideshow, so I would like to share my screen. Uh, I hope that the screen is also visible. Is it?
Yes. It's visible.
You can see it, right?
Yes.
Okay, thank you so much. So my name is Joshua Murauzi. I'm an accountant at Next Generation Accountants. If you want to identify us, you would identify us with this logo. And then a bit about me. We are registered accountants and tax practitioners. Uh, and right now I'm on the verge of obtaining a license called NPO Accountant Practitioner. Uh, that is why, that is how I am in love with NPOs. I actually want to be a specialist when it comes to NPOs. So next generation accountants, we provide accounting, tax, and advisory services to companies, individuals, and NPOs. And I have to say that majority of our clients are non-profit organizations. So we do love NPOs so much. Uh, about our presentation for today, uh, when I was actually rehearsing, it showed me that this will take about 30 minutes. Uh, but my pace is going to be a bit fast. Uh, but I hope that everything will be clear, as we'll also have a question and answer session. So this is what we're going to talk about today. Uh, you will know what compliance is, because my presentation is all about compliance. So I will tell you, you will know the definition of what compliance is, and then we'll talk about NPO compliance for non-profit organizations registered with the Department of Social Development. We'll talk about NPC compliance for those non-profit organizations or non-profit entities registered with the company's CIPC. And then we'll talk about labor laws compliance. We'll talk about income tax compliance, or rather SARS compliance. And then we'll also talk about PBO compliance. So I had I don't want to pronounce the name incorrectly. The previous presenter, she talked about income tax. Income tax. She talked about PBO, and she did touch a lot about PBO. But with me, I'm going to be talking about how you comply with PBO, because she did touch talk about who can register and maybe how to register. But I'm going to tell you how, when you are a PBO, must comply. And then we'll have a question and answer session. I hope I'm clear. So far, so good. So what is compliance? In simple terms, it means adhering to the laws and regulations. So when you are an NPO, once you register an NPO, you are required to comply with the NPOs Act. So that is compliance. And when you are an NPC, you are required to comply with the Companies Act as an NPC. And I know that there are organizations that are registered as both NPCs and NPOs. So they have two certificates, or we call it dual registration. So when you have two certificates, you don't choose which one you comply with. You have to comply with all of them. As an NPO, you have to follow the NPOs Act. As an NPC, you're going to follow, you also must follow the no, not the NPC Act, Companies Act. So in this presentation, I'm going to show you how you should comply, whether you are just an NPO or NPC, or whether you have both. So I'm going to show you how you should, what you should do to comply. And the importance of complying, there are a lot of benefits when it comes to compliance, because also not complying has negative consequences. You could be penalized. You know, SARS penalizes non-compliant taxpayers. You could be imprisoned. You could be fined. So there are very not so good consequences. And then, but when you comply, you build this public trust. You also attract the right people into your organization, like donors. So there are benefits when you comply, and there are consequences when you do not. So I'm going to show you how to comply so that you enjoy the benefits of compliance, so that you get donors getting into your organizations to support you. Yeah, I forgot that this is not a spreadsheet. It's not a PowerPoint. Okay, so in terms of NPO compliance, the very first thing that you must comply with is with regard to record keeping. You are required by the NPOs Act to keep detailed records of income and expenditure. This is what we call, most people call slips. Slips. They call them slips. So you have to keep those receipts, and invoices, and bank statements as well. Bank statements, records of income and expenditure. On our website, and in the Facebook group, if you are from the Facebook group that I'm a member of, you'll notice that I've already shared templates for keeping income and expenditure records, and also donations. So you have to keep accurate records of income and expenditure. Why should you do this? Because you use them for SARS purposes, and also to prepare financial statements. So the first compliance matter when it comes to NPOs is to keep financial or accounting records. And your accounting records are your bank statements and slips. Sometimes you might also have books wherein you record these things, and then they will be supported by those records. Let me not spend too much time. Okay, and then compliance issue number 2 is financial statements. Every organization, every NPO must prepare financial statements 6 months after its financial year end, and this must be done by an accountant. Most clients would ask me, can our bookkeeper do this? No, it is not your bookkeeper that can prepare financial statements. It is your accountant, a registered accountant. The Act is very clear when it comes to this. It says a registered accountant who belongs to a professional body. So you have to prepare financial statements. So most of the organizations' financial year end in March. So this means that by September, because it's 6 months, by September, you should have prepared the financial statements with your accountant and submitted them to DSD. But you submit to DSD within 9 months. It means that within 6 months, prepare financial statements. And then within 9 months, actually 3 months after preparing them, submit them to DSD. This is what I'm talking about. You submit them now to DSD. And what do you submit to DSD? DSD means Department of Social Development. So what do you submit? You submit 2 reports at the end of your financial year every year. You submit 2 reports. One is called the narrative report, and the other one is the financial report. The financial report is the financial statement that we talked about in the previous slide, the one that is done by the accountant. The narrative report is the one that you can do yourself. You actually should do it yourself because it asks questions that are very specific to organization. So even if you are being assisted by an accountant, they will just call you and then they will be completing the forms on the phone, because this the questions that are there are very, very specific to your organization and needs someone who knows what was going on throughout the year. So you submit 2 reports to DSD, financial report from an accountant and the narrative report. And you get the narrative report from the internet. You can just Google narrative report, DSD narrative report, they will give it to you. Yeah, so we're done with NPO compliance. We said you should keep accounting records, prepare financial statements. After preparing financial statements, submit them to DSD. And also do not forget that you should notify DSD of any changes to the organization. If you change office bearers, maybe you are appointing a new chairperson, there is a form that you should complete and send to DSD. If you are changing the constitution, there's a form that you should complete and submit to DSD. So notify them of these changes. Yeah, so we're done with the NPO compliance. Now we are coming to Companies Act compliance. Companies Act compliance is for non-profit companies, NPCs. If your organization is an NPC, know that the first thing that you should do, this is after registration. We assume that you already have an NPC. This is after registration. So this is how you comply. Item number 1, issue number 1 with regard to NPC compliance is filing of annual returns. Sorry. So while with NPOs you file, you submit annual report and the narrative report. With NPCs you submit the annual returns. You still need financial statements to file this, even though you do not submit them manually like with DSD. With CIPC, you just capture on the system when you submit. So you submit the annual return when on the company's birthday. This means that if you have registered the NPC on the 1st of January this year, next year on the 1st of January, it is celebrating a birthday. So within that month, you should, or actually, yes, after the birthday, you should file what we call the annual returns, and you need financial statements to file annual returns. And then issue number 2 when it comes to NPC compliance is keeping of financial records. Now this is like a repetition. You have to keep financial records when it comes to NPOs, and you also have to keep financial or accounting records when it comes to NPCs. So you see, there's a list of what information you should keep for both NPOs and NPCs: bank statements, invoices, receipts, contracts, payroll records, and any books where you record your income, expenditure, any financial record, anything where you record money, and also non-monetary transactions. You have to keep those records. This is important for filing your income tax returns and also compliance with CIPC annual returns. And then let's move to issue number 3. It says again, you have to prepare financial statement. This is according to the Act. We're not just coming up with these things. This is according to the Companies Act. So it says you should prepare financial statements within 6 months again after the financial year end of the organization. So after the financial year end of the organization, talk to your accountant, submit the accounting records to them, and then prepare financial statements. And then after preparing financial statements, you have to file annual returns. You also have to file income tax returns and use them for whatever reason that you have to use. If you are applying for funding, you still use the same financial statements. You don't have to prepare financial statements for SARS, for CIPC, and for funding. One financial statement is enough for everything. And then again, you'll notice that these things somehow overlap. Again, with NP, with Companies Act, compliance, you still have to notify the commissioner of any changes to the organization. If you are changing directors, appointing another directors, or another directors resigning, you are changing the address of the organization, you have to file that with CIPC. With NPOs, you have to complete a form manually. I think it can also be done online, but mostly it is done manually. You take those forms and submit to DSG. When it comes to CIPC, everything is done online. If you're changing a director, you go to the CIPC website and change that. So you have to notify them. That is how you notify them. And then still on the Companies Act, this is the last item on Companies Act. There is this new phenomenon called beneficial ownership. So this one is like declaring who are the shareholders of the organization. But since non-profit organizations do not have shareholders, they do not have owners. You do not. No one owns an NP, a non-profit organization. No one. So it's all about who controls. With regard to non-profit entities, it's about who controls this organization. So you have to go to the CIPC website under beneficial ownership, and then file the details of these people to say these are the people who control the organization. So it will be the office bearers in this case, in the case of NPCs. But non-profit NPOs do not have to do this. It's only NPCs. And then yes, so beneficial ownership. So if you have not yet filed this beneficial ownership and you are an NPC, please do so as soon as possible, because there are consequences. There are penalties, fines, and imprisonment. And then we're done with NPO and NPC compliance, but we're still talking about how you should comply as an NPO and NPC. So this one covers both entities. Once you employ your first staff, whether that person is a casual employee, permanent, or contractual, you have to register them with with the Department of Labor. So this is how you comply with the labor laws. At the basic level, you have to register with UIF and COIDA. Your employees, with UIF and COIDA. And at the end of each month, you don't only register and get a registration number, because I've seen some clients will say, okay, we have a tender that we want to apply for. We need COIDA. They also need UIF. And then once you register them, they think that it's over. They just needed the the registration number. No, it's not over. Once you register with UIF, it means that you have to submit UIF returns to the Department of Labor every month. It's meaning that you have to deduct UIF from your employee salaries, and then you have to pay that over to the Department of Labor every month. But unlike with COIDA, you only register, you file it once every year in April. Yes. And then ensure that all your employees are registered, and also that you declare or you submit your UIF returns every month. That is the basic when it comes to labor laws. And yeah, that was all about labor law. And then SARS compliance. This one is a big one, because most organizations, especially NPOs, were registered very long time ago, and they still do not have an income tax number. But once you register an organization, it becomes a taxpayer. Even a baby that was born today, once they are born, once they come into this world, in South Africa, they become a taxpayer, because everyone is a taxpayer. Even children, even babies are taxpayers. So once you registered your NPO, you became a taxpayer. So you have to immediately register with SARS and get a tax number. It is better for non-profit companies, NPCs, because immediately when they register, they also get a tax number. But with NPOs, you have to go a step further and register for a tax number. And once you get the tax number, you have to submit 3 income tax returns per year, depending on when your financial year ends. If your financial year end is March, it means that by September, 6 months, it's 6 months. First provisional income tax return in September, you submit, and then another one in March again. 6 months, 6 months. And then there is also one annual return, the third one. This one, you submit it after preparing your annual financial statements, the financial statements. That is 6 months after the financial year end, somewhere there, you must submit the annual income tax return. So 3 income tax returns per year. However, PBOs, because PBOs only submit once at the end of the financial year. If you are a PBO, you only submit once a year. You don't submit 3 times like NPOs that are not PBOs and NPCs that are not PBOs. Yeah, so this is what I was explaining, that you have to get an income tax number as an NPO. NPCs already have tax numbers. As an NPC, as an NPO, register to get a tax number, and then also apply to become a PBO. Apply to become a PBO. This is very, very important. We're still going to talk about PBOs. Or actually, the next slide is about PBO. Apply to become a PBO so that you do not pay tax. You are an NPO, you are not supposed to be paying tax. But if you don't apply to become a PBO, you will have to pay. Yeah, so we're done with SARS compliance. Let's talk about, it's still SARS compliance, but that was income tax compliance, and then now we're talking about Section 18A. So when it comes to Section 18A compliance, okay, maybe let me start with what Section 18A is, what PBO is, and then we can get it. Okay, so as an NPO, as a non-profit organization, okay, sometimes when I say non-profit organization, I'm referring to both NPOs and NPCs. So as a non-profit entity, so the government actually has seen that, okay, these organizations that are non-profit entities are actually doing the job that we as the government should have been doing. So why don't we make them not to pay tax? And then they came up with this thing of PBO, or tax exemption. But however, this is not automatic. It is not automatic. You have to apply for it. If you do not apply for this status called PBO, then you will pay tax. But if you apply for it with SARS and get the status or get approved, then you will not pay tax. And then there are two types of PBOs. There are normal PBOs, these ones do not pay tax, and there are PBOs who have also what we call Section 18A status. So they have two statuses, PBO and Section 18A. So the Section 18A is those okay, the benefit of the Section 18A certificate is that when donors donate to your organization, you give them this Section 18A certificate, and then when they go to SARS to submit their income tax returns, SARS will reduce their tax liability. So that is why they will love to donate to organization, because it reduces their tax liability. Yeah, that is Section 18A. I believe that if there is anything that is not clear, you will ask questions and then we'll clarify it. So there are rules as to how to comply with the Section 18A certificate. You don't just share the paper and then give to anyone. You don't do that. So when do you give a Section 18A certificate or receipt to a donor? When a donation is two conditions. Number one, it has to be what we call a bona fide donation. This means that it's a genuine voluntary gift made by a donor out of kindness or generosity, not a transaction. It shouldn't be, give me, I'll give you this if you give me this, or give me this and then I'll give you this. That is a transaction, it's a trade, it's not a donation. But when it comes to Section 18A, SARS says the donation should be a bona fide donation, which means that it has to not be a transaction, but a voluntary gift. Number two, this donation should be used towards an approved program. If you look at your PBO approval letter, they will give you a list of which programs they have approved in your organization. Isn't it that you might be providing maybe 5 programs, and then if they approve 3, those are the approved programs, and you only issue the Section 18A certificate for the programs, for donations that will be used towards the approved programs. So this is just you being faithful now. But even if you are not being faithful, the auditors will find out and you'll be in trouble. So if a donor says, okay, you have a sub-kitchen and your sub-kitchen is an approved program according to SARS, is an approved program, then if they donate 10,000 and say this should be I'm donating this towards the soup kitchen. Okay, we are going to use that money, all of it, on the soup kitchen. You're going to use it on the soup kitchen. We shouldn't find you having, as accountants or auditors, we shouldn't find that you used that uh, 10,000 to buy things that are not related to the soup kitchen. Otherwise, you'll get an unclean audit, and that could sabotage your PBO status. SARS can take it back. Sorry, and then and if a donor knows that you are a PBO and then is coming to donate, but is donating towards a program that is not an approved program, just tell them that they will not get the Section 18A certificate, because even if you give it to them, when they go to SARS, they are not going to win, and then they will come back to you, and then it won't build a good relationship. I hope this was clear. And then, yeah, this is what I was explaining, that all donations was for which Section 18A was issued. If you have received a donation to be used for a certain program, use it for that program, because auditors are still going to come after you, and then they will have to prove that indeed you have used the donation towards an approved program. So, and then another compliance matter when it comes to Section 18A is with regard to documentation. Keep accurate records and all the records of donations, everything that you've received. You also have to note down the name of the donor, their address, their email address, their contact details, their names, if it's a company, the company registration, company registered name, trade name. You have to have all this information, because you are also going to need it to complete the Section 18 certificate. So yeah, and then like I've also said something about audit. There is what we call audit certificate. If you are a PBO and you also issue Section 18A certificate, you have been approved to issue the Section 18A certificate. If your programs, if maybe you have 5 programs and 2 are approved and 3 are not approved, it means that some of these programs fall under what we call Part 2, some fall under what we call Part 1 of the 9th Schedule of the Income Tax Act. And in this case, it means that you are required to have an audit certificate. You must do it at the end of the financial period. But those organizations that have maybe only one program, and then it is approved for Section 18A, they are not required to produce the audit certificate when they file their tax returns. And okay, so I'm done. So I know that there might be a lot of things that I did not touch, or yeah, touch, because there is a lot to talk about. So through questions, I believe that we'll be able to address them. Thank you so much.
Okay, thank you so much, Mr. Mulauzi. And then I'm going to open the floor for questions. I see there's a few participants. So please raise your hand if you have any question, and then we'll come back, Yvette. Yvette is back, so we can direct questions both to Mr. Mulauzi and Yvette. Thank you. Yes, Stephanie, you have the floor.
Okay, thank you very much. I just came in on this is just something that I need clarity on in terms of the report to DSD. I know in the past we used to send them those mountains of documents. Joshua, you just said that they only need a narrative report and the Fs. Is that all that is required by them? Nothing else?
Uh, sorry. Yes, Stephen. Those are the two requirements to submit on an annual basis: the narrative report and the financial statements. That is the only thing that they require. But if you have made changes to your constitution, you'll also have to submit a form called a change to, okay, I forgot the name, but with regard to changing of the constitution, or if you have changed the office bearers, let your submission be accompanied by those changes. But however, on an annual basis, you are required to submit only two reports: the financial report and the narrative report. Thank you.
Thank you very much. I just want to clarify, do you know if there's a latest narrative report that I could find online first? Because I just find PDFs. Then I'm done.
Do I know where you can get it?
The latest narrative report for DSD.
Okay. I also use the old ones.
Okay, that's fine.
Yeah, yeah. I
Thank
also,
you.
yeah, she's very right, because I also would struggle very much getting the latest, because I think there's one on the internet written 2006, I think 2003. Yeah, but it is still relevant. Nothing has changed.
Thank you very
So
much.
you can use it. Thank you.
Sonwabo, you have the floor.
Good afternoon. I just need a clarity on section 18A, whereby you mentioned that if your project is not approved, so what do you need? What I must do if my project is not approved? Thank you.
Okay. What do you need to do? You don't have to do anything. It means that it does not meet the qualification criteria. Like I have indicated on the slides, that there are programs that fall under part 1. There are part 1 programs or activities, ne? And then there are programs that fall under part 2 of a document called 9th schedule of the income tax. So if all your programs fall under part 1, you will not be able to get section 18A certificate status if they fall under part 1, all of them. But if you have programs that fall under part 1 and part 2, then those that fall under part 2 will make your organization get the section 18A status. And you can't there's nothing that you can do. Let me give an example. If you are a sport, your organization focuses on sports. Sports activities fall under part 1 of this schedule, of this document. So if you are a sport organization, then you will not have the ability to get the section 18A status. So you see that there is nothing that you can do, because on the form you have to indicate that we are a sporting organization on part 1. On part 2, you won't find an option to tick that you are a sporting organization. So it means that you have lost that status of being a Section 18A. However, you'll still be a PBO and you will not pay tax, but you will not have the advantage of issuing the Section 18A certificate to your donors. I hope you are answered.
Yes, thank you so much.
All right.
Okay, Mr. Mulauzi, a question to you, my good sir. So, what are common financial challenges are faced by organizations, and how can we then address them while staying compliant?
Financial challenges. Mm, this one is a hard one. It's a difficult one. But when it comes to NPO finances, what I've realized is to find an organization struggling financially is because of lack of planning. Is because of lack of planning. First of all, the most basic thing that they do not do is budget. They don't know what is going to happen this month, how much they are going to receive, how much they are going to pay. Everything just happens spontaneously, haphazardly. There's no plan. And when you have no plan, when you have no financial plan, uh, you tend to struggle financial, because if you do not know that this month we are going to pay 100,000 in expenses, how are you going to plan how to raise that amount of money? So in my experience, it's lack of planning. And maybe the second thing is not having people who are committed to the organization. Because you might find that people in the organization, they have money themselves, but to contribute to the organization, they don't. So commitment to the organization also uh, could really help. So it's planning. Thank you.
Okay, thank you very much. Another question. So what are some key performance indicators or financial metrics that we should regularly monitor to assess financial health and compliance of the organization?
The can you please repeat the question?
Okay, so what are the some key performance indicators or financial metrics that we should regularly monitor to assess the financial health and compliance of the organization?
Mm. Mm, let me just be general as to which key issues to look at. Okay, the number of donors is a key indicator of whether where your organization is heading. The number of donors. If you have never gotten any donation, or you have very few donors and the amount that they contribute are very little, it does say something about the sustainability of your organization. So one of the key indicators of a successful organization will be the number of donors. The other one, the number of fundraising activities that you implement. The number of fundraising activities that you implement. Because if you don't raise funds and there are no donors, so it means that you'll just be taking money out of your pocket, and that is not a good thing. The other thing Okay, yeah. So I think those are the two most important things to look at. Thank you.
Thank you very much. So, since we're in the fourth industrial revolution, there are changes, and then there's change in technology, and also there will be change in terms of current softwares that are used by for accounting purposes. Can you please recommend to this organization which ones are the best and which ones that we not we might, that we don't have to touch? Because remember, there are also freewares that are available for us to use, but how can that implicate us as far as financial practice is concerned? Thank you.
Can you please repeat the last part of the question?
Okay, so some of them are freeware that we get from the internet. So if we are using them, what are the implications then we can find ourselves in as far as accounting practices are concerned?
Yes, there are free accounting softwares that our NPO organizations can use. However, the only problem that I have with them is is with the limitations. They will have limitations. They will have limitations as to maybe how many transactions you can capture in a month, and thereafter they will say you have to pay a certain amount of money on a monthly basis if you want to exceed this cap, and that might not be a good idea for NPOs, especially small NPOs, because it could put them under a financial constraint. So that's the problem that I don't actually have a list of best accounting softwares or bookkeeping softwares for NPOs, because an NPO is a different kind of a business. It's a different kind of a business. So it actually needs its own accounting software, an accounting software that is tailored for just for NPOs. So what we use normal accounting softwares, but we tailor things in there to fit NPOs. For example, we use QuickBooks. We use QuickBooks. So you'll see that you'll find that when on QuickBooks you issue invoices, but since you are an NPO, you don't sell. How do you issue invoices? You see such things. That is what we do internal to say, okay, so for this thing to suit an NPO, let's do this. So it becomes very hard to actually recommend an accounting software to maybe to an NPO, because it will also take them a lot of time to learn it. Because I actually have a one client. She uses this software called Donor. It's called Donor what? Active Donor. It's called Active Donor. So she sent me a report, and then I started questioning some of the things. She said, okay, actually I was learning and then I was recording things. Oh, it was it was a mess. So even though we are in this fourth industrial revolution, and yes, indeed we have to adapt to technology. People have to know how to use technology. However, some of these technologies can be very hard to use. Yeah. So to answer questions, I don't really have a list of best packages. Yeah, but And also these online, these free ones, they tend to have what limitations. And also when you use free tools, be sure that you are getting something from a reputable company, so that they don't steal your information and stuff. Yes, thank you.
Okay, thank you very much, Mr. Mulaudzi. Yvette, there was a question that I asked previously, but unfortunately you had a challenge. So a question directed to you. So you've mentioned that there are various ways in terms of registering your organization. You mentioned the NPO, you mentioned the Trust and Volunteer Association, and now know that we also have CBOs within our communities. Now the question is, can you then, as a CBO, uh, register as a public benefit without going through the NPO process or the trust process or other processes that are there? Can you do that?
I think Maximo sounds like he might be able to answer this question, Joshua, better than I can. But my understanding is that in order to be a PBO, you would first need to be an NPO, or you would need to have had that initial registration. PBO is essentially about your tax status. If you are a community-based organization, you would still have to be associated in terms of one of the three main forms, I think, of not-for-profit organization that I've mentioned. So you can be a community-based organization and a voluntary association. That's generally the normal kind of combination. But you could also be a community-based organization and an NPC even, So it's a little confusing sometimes because these terms, we use them to both describe the function of the organization. We use them to describe the registration of the organization, like who we are accountable to. And then we have certain terms that are related to our tax compliance and that are more directly related to the financial status of the organization. And they sometimes overlap. And so you can have several statuses at the same time, if that makes sense. So in other words, you can be a non-profit organization that is also a non-governmental organization that is also a public benefit organization that also has Section 18A, for example. They're not mutually exclusive of one another, but they are indicating different things about you. I don't know, Joshua, if you want to add anything to that explanation.
No, nothing to add. You explained it very clearly. Because yes, some of these terms that we use are not actually what, I don't know how to put it, but for example, when we say that an organization is an NGO, there is no legal registration for NGO. You can't. There's no way you can go and say I want to register an NGO in South Africa. You can only go to the DSD and register an NPO. Go to SARCEL and register a trust. Go to CIPC and register a what, NPC. But you'll find that an organization calling themselves an NGO. So you explained it very, very well, very clear.
I mean, one thing which I would say just on the financial tools aspect is that I mean, obviously there are financial tools that can be very useful if you can either afford them or, get to work with them in ways that make your life a lot easier. When you start to have an accounting package, for example, that is linked to your bank account and where you can see that every single transaction is being pulled through to that financial pack, that online package, and you're then able to allocate and that kind of thing. Obviously, it's going to make your life a lot easier than just having to start on kind of a paper-based exploration of what's happening. But having said that, I do think that the tool that many people don't spend enough time really trying to understand and use well is Excel. Because Excel is such an incredible tool, actually. It's got so many elements to it that most people don't even know about. Most people will just use Excel to, add things up. And that's all they'll kind of do. Or even just to lay things out in a kind of a block format, and they don't realize that there are so many things that you can do in terms of your record keeping with Excel that can be incredibly useful to you. So I would say that if as an organization you don't have a strong financial base, maybe the first thing to look at is just there are lots of free online tutorials for how to use Excel better. And just take yourself through a learning process with Excel. And I think you'll find it will make an enormous difference to your capacity for financial management. Because whether it is dealing with large amounts of funding or whether it's simply dealing with petty cash, a well-designed Excel spreadsheet can really help you make sense of what's happening in your organization.
Okay, thank you, Yvette. Another question directed to you. So, what are some key performance indicators of good governance that should always monitor to assess good governance or due diligence?
So, I mentioned earlier ICRAFT and the kind of principles that are in the King Commission's in King 4 in the kind of proposals around how such an organisation should work. But I think that we can kind of extrapolate those down into key performance indicators. And so if we're talking about, for example, a board's KPIs, how effective is the board going to be? Then some of the things that you would be wanting to look at is, firstly, attendance of meetings is absolutely, vital. So you need to ensure that your board members are regular attendees, that there are proper apologies given. You need to make sure that your board is compliant with the aims, values, principles, and policies of the organisation. So do they know those policies? Have they been involved in drawing up those policies? When they reach a moment of difficulty, if there is no policy that addresses that particular moment of difficulty, do they take time to, in fact, look for a kind of a policy framework that will work for them as they grow the organisation? So I think their capacity to develop policies and then comply with the policies that they've developed is a very important part of the KPIs. And then obviously, there are some basic things around your oversight duties. So, are you reading the reports? Are you actively interrogating the reports? So if you have a situation where you've got a board and you've got a management, you want to have a kind of a respectful but a robust kind of conversation about what's happening. You want the board to be asking questions about, for example, I think Joshua was talking about such an important aspect of planning, So you want the board to be asking those questions. Can we afford to do this next project? Where is the money going to come from? Do we have long enough time frames for it? So you want to see an active engagement, which is not the same as you don't want them to be obstructive. Obviously, the board needs to be there to support the workings of the organisation, not to get in the way of the organisation working. So it's not about saying no to things, although sometimes maybe a board will have to say no to something. But generally, it's about really providing support to the management team, but making sure that the right questions are being asked. And then very often in boards, there's also a case of needing to actually deliver on tasks. Some boards are more advisory, but generally when organizations start out, you'll find that the board is in fact the people who are engaged in the running of the organization, and very often there will need to be tasks that they do. So you could have a KPI which is about the fulfillment of tasks. Are they doing it to the best of their abilities? Are they doing it within the agreed timeframes? You know, are they responding to requests for information in time? So that could be a whole area of KPI. And then you also want to have a board that is present. So are they supporting the organization? You know, if your organization has a fundraiser, for example, are they physically present at the fundraiser? Are they speaking to potential donors? So their capacity to be engaged, physically visible, or visible in terms of networking, visible in terms of how they engage is very important. Some boards have a KPI around how much board members are able to raise for the organization. And that is a challenging, but I think a positive kind of KPI to have, because it gives people a very specific target, you know, and it says we expect you as a board member to raise funding for this organization. So you could think about such a KPI. Of course, all the things that I'm suggesting here are not have to haves, but I would say that they are desirable KPIs. And the way that board members could raise that funding is by either introducing the organization to people who want to donate, opening doors to other partners, perhaps representing the organization somewhere where funding lead becomes apparent, that kind of thing. They don't necessarily have to be giving to the organization directly themselves. You know, that's not necessarily what's being asked there. So I think those are the kinds of KPIs that you would want to have for a board. And then there may also be KPIs that are directly linked to some of the important things that the board does. So, for example, the audit. You know, we would want to have for an organization, you'd want to have a clean audit, an audit where you don't have a lot of questions being raised. So you might have an audit committee, and you might want that audit committee to reach certain targets. So, for example, if in the last audit, the auditor raised some questions about particular areas of how your organization is running, a KPI for the next year might be that your audit committee is going to ensure that those particular questions are dealt with in such a way that the auditor will be satisfied at the next audit around whatever improvements you've made in the way that you run. You might also have a KPI around appointment of positions, because often the board is involved, particularly in the appointment of the director of the organization, and in holding that person accountable. So, there may be something around that. But obviously, it really depends on what you want in your organization to achieve and what the level of involvement of the board is going to be, when you draft your KPIs. So you don't want to make your KPIs so difficult that no one wants to serve on your board, or that those board members that are, serving on your board aren't able to actually meet the basic requirements. So you need to be realistic as well.
Okay, noted. Thank you. I like the fact that you emphasize on the fact that we as organizations, it's very important that we have our own policies that will help us accountable in the future. And then last question, have you observed that most of the organization, when they are starting, the board is also the working committee. So what are the advantages of that? And then what are also the disadvantages of people serving both on the working committee and also serving on the board? Sorry, you're muted. You're muted.
Sorry. I think one of the advantages in the early days of an organization's start is that generally when people gather to create an organization, they do so with a real sense of intention, and they have come together because they really believe that this thing, whatever it is, needs to be happening. And so often in startup organizations, having the board also being the kind of volunteer staff, if you like, creates a sense of purpose, shared purpose, a sense of community, a sense of energy. And if you can make that group really work well together and trust one another, it can be a very effective way of getting an organization off the ground. I think one of the disadvantages of having no separation is that there is no oversight necessarily. So the people who are responsible for the money are also the people who are receiving the money and paying the money out, etc. And so, if somebody is being dishonest, or if somebody is, and maybe even not being intentionally dishonest, but perhaps disorganized, or making mistakes or whatever, there may not be anybody else in that group of people who can hold that person to account. When you start to have a separation and your treasurer is a different person from your finance manager, and your chairperson is a different person from your director, then it means that there's a sounding board for the people who are playing the roles on the management side. They have someone to go to, they have someone to ask advice from, and they also have someone who's kind of keeping check on them and making sure that they're doing what they need to be doing. So I think there's definitely value in that separation. If you are in a position where you're currently needing to do both because basically you can't afford to pay anybody, you don't have staff, and so the people who have formed the kind of management team, the board, have to actually do the work. Then I think you've got to look at ways to hold one another accountable and to make sure that some of the disadvantages of not having that separation are overcome. So you might want to, for example, have, instead of just having a chairperson, make sure that you also have a deputy chairperson, to hold the chairperson accountable. Instead of having just a treasurer, have a treasurer and maybe a deputy treasurer, and the deputy treasurer is somebody who helps hold the treasurer accountable, and vice versa. Make sure that you've got sufficient oversight within your structure, so that everybody can stay on track. I think a moment of difficulty for many organizations is when they start to transition from being a purely voluntary board who's doing all the work to being a volunteer board on the one side and staff on the other. Very often that's a moment that's quite difficult to navigate for organizations. And, so the first time you employ somebody, obviously, as Joshua said earlier, the moment you employ one person, you need to be looking at labor regulations, right? So there's a whole lot of other things that start to come into play then, another level of oversight that needs to happen. And so, I think it's important to navigate that moment and to really negotiate properly and for people to understand their roles. If somebody was the chairperson of the organization, but now they are the person who's the manager, they need to understand that they are the manager and that they answer to the chairperson, so it's important that people are really clear on what their roles and responsibilities are as that separation happens.
Okay, thank you very much. Nongi, you have the floor.
Good afternoon, everyone. I think Yvette has cleared me, Chairperson, on my question. I just wanted advice on, since you're speaking on governance and admin, that in a case of a trust event, do you think that it's wise that a trust should have this one, as you explained, the voluntary association board? Do you think it would be wise enough for a trust to have that voluntary association? I'm not sure to say, maybe as a mediator to its governance, or as a board that oversees the trust with its issues that it can't overcome. I'm not sure how, but I feel that my question is it wise enough to have that association, that board that's going to be there to advise a trust itself? I'm not sure if you get my question, but I think you've answered somehow.
I mean, I think that what I would say is that generally speaking, the trustees who are appointed to the trust are the ones who should be doing the oversight. So there should be other people who are doing the work who are not necessarily trustees. Generally, that's the way it works rather than the way you've just described it. So the trust would appoint certain people to be part of the management team, for example, and those are the people who are doing the work and getting paid or whatever through whatever funding is raised by the trust. I don't know, Joshua, if you have any examples of where it works differently, but that's certainly the format that I've encountered most often. I don't know if Joshua is there to answer that. But yeah, I mean, I think it goes back to what I was saying, Nonki, that you know, having the separation is important and is valuable. And you need to look at what people's strengths are and whether they should be playing a role within the oversight, committee, whatever form that takes, whether it's a board or a trust or whatever, or whether they are needing to be the implementers. And often the question will be answered by how much time they're giving to it. So the people who are implementing need to have more time available in order to do that implementation, whereas the board typically is not as involved, so they're not giving as much time. And according to regulations, you need to meet at least quarterly as a board. And obviously there's some boards that meet more often than that, but and particularly if it's a board that's also managing, then obviously it will meet a great deal more than that. But in terms of compliance for boards, they need to have 4 meetings a year and an annual general meeting.
Yeah, okay. Thanks, Yvette. Thanks. Chair, I had a question for Joshua, and I see that he's not responding. I'm not sure if he's off the line.
Mr. Mulaudzi?
It's fine, Chair. I'll note the question down.
Okay then. So if you have any questions, please do send me those questions so I can send them directly to Yvette or Joshua, and then I'll send back their response. So I'd like to thank everyone who has attended this webinar. And also please note that this webinar will be streamed later today for those who wasn't able to attend the webinar. And then it will also be shared on YouTube, on our YouTube space, where people can easily access. And then if there are those with questions, then questions will be redirected again to Yvette and Joshua. Thank you very much again for your time. If there are no questions or point of clarity, or are there any last words Yvette before we end this session?
No, nothing from me. I don't know whether Nonki has another question.
No, I actually had a question for, because I think also you as a director of a very huge, broad organization, having an accountant, financial person in office, I think maybe you might help with this question, because what I wanted to ask Joshua was that how do your client ensure the confidentiality and security on your financial information, and beside them just bringing basic accounting services, what other values do they bring to their clients than just looking at the basic accounting services that they actually that what we are looking at? What are the other values? Yeah, for those.
Well, I think, yeah, I mean, I think the point that you make about discretion is really an important one. It's it's really people's financial information. And if you think about particularly the kind of laws that have come into play now with the protection of personal information, you know, it's not just financial information that needs to be kept, you know, private if it's someone's private information, but in fact all information about them. So we do have a responsibility to practice discretion, and I think that accountants, you know, in particular, are taught that as a core kind of value. But it's important that within the organization that you also have that you respect, you know, those kinds of principles. It doesn't mean secrecy and lack of transparency, though. You know, so it's about like you can't talk about anything now because it's personal information. It's about how that information gets used, how it gets put out into the public, how it gets shared with others. So those are some of the things that need to be considered. And I think that one of the things that that Joshua was raising around organizational planning, that's something which an accountant or the financial manager within your organization can also really bring to you, is, you know, being able to say, look, in terms of what we currently have in the account, your budget for the next 3 months is unrealistic, or, you know, or in other words, to raise flags when they can see that there is a problem in terms of cash flow or whatever. So yeah, I think that there are when someone is coming with financial skills and they're doing work for an organization, there are a number of things that they can offer which go beyond just providing, you know, spreadsheets and financial reports. But they should really be working hand in hand with the person who's doing the management to make sure that you keep any project on track, and particularly that you keep things within budget, you know, and that the budgets are realistic.
Okay. Okay, thank you. Also, just a last question, Chair, under you, sorry. We're speaking of community centers, and I think, Yvette, these were questions for Joshua, but I think you're also capable to answer these questions because you work closely more with community centers, and you know that you'll be speaking of centers that are not financially stable. So when it comes to these accountants, is there any system in place, maybe to say pro bono for those that doesn't have money? You want to have the system in place, but you don't have, because you're speaking of someone that's qualified, someone that's looking forward to be paid at the end of the day. But is there some sort of an arrangement that can be done to say maybe pro bono, or I don't know, Yvette, I'm not sure if you understand me, but just speaking of
you can, absolutely. I mean, and I think, you know, so there are accounting firms. So firstly, you know, many organizations, many companies need or want to do some work for social good, right? And that's part of corporate social responsibility. And so often some of the big firms will do a certain amount of pro bono work because that's the way that they can best demonstrate that social responsibility. And also the thinking is that, you know, if I commit some time pro bono now to this organization and we help it become more secure and it grows over time, they will then become a client of this of the organization, you know. So they kind of are thinking about sort of building relationships long term. So you can find some pro bono assistance through firms. Sometimes you'll find individuals who are willing to offer their time. Sometimes it's because the individual perhaps has a, you know, there's some kind of a connection to either to the community that is being served, or to the particular focus of the organization. So it's not impossible, but I think it does require relationship building, obviously, and it requires also, you know, looking for the right people. And ideally, where you'd like to bring someone like that in initially is maybe not in a like a functional role. I'm not functional is the wrong word, but in a kind of a you know, like a role like a finance manager, and more in the role of, say, treasurer. And then from there, maybe, you know, once you've once you see that, and you can talk to them about the fact that your organization is not coping with what they need to do, perhaps they would take on more financial management for you. But it does require trust and relationship building. So it's not something which is going to happen overnight, but it is possible, absolutely.
Thank you, Yvette. I'm covered, Chair. Thank you.
Okay, thank you very much. Just got an indication from Mr. Mulaudzi. He had a technical errors. But thank you very much, guys. Thank you very much, Yvette, for very insightful information in terms of governance. And thank you very much, Mr. Mulaudzi, also for insightful information in terms of compliance as far as accounting is concerned. I look forward to more webinars where we can have such platforms where we are discussing these issues. I think when you talk about them, it will be much more easier then to implement, because I think most of these webinars are more into giving information and are not open for dialogue. And I do believe through dialogue, there will definitely be implementation. And thank you very much. Thank you very much, Nonki. Thank you very much, Sonabo. See you soon.
Thank you. Bye.
Bye.
Thank you.
Bye.
Bye bye.
Sure.